Hello and welcome to Live Wire Markets. I'm Hunsley and this is The Pitch. We're going to compare Australia versus the Asia Pacific in this episode, and specifically from a credit or corporate fixed income perspective. And the man tasked with doing that is John Stover. John is the portfolio manager for the Tribeca Asia Credit Strategy. He's normally based in Singapore, well, we've got him here in Sydney. John, welcome.
Thanks very much.
So most people watching this video will be from Australia who are incredibly home biased. So just to start with, why do you think Australian investors should consider not just credit, but Asian credit in particular?
Yeah, so I think we're at a really interesting crossroads for Asia credit, because if you look at what's happened in terms of fund flows in the region, you saw money leave Asia during COVID, really sort of March 2020, April 2020, and that's because the Fed, US Fed, and the European Central Bank announced they were going to buy individual corporate bonds. So that really backstopped those markets during that COVID sell-off. You didn't see that same thing in Asia. And then really since then, you've had kind of this cascading of negative factors in the Asian credit market. So you had the China property crisis. You've had negative emerging market sentiment because you've had, the Russia-Ukraine situation, rising US dollar, rising interest rates in developed markets, which are generally, negatively correlated to emerging market sentiment. And, what we typically see is when interest rates are hiked, so that rising rate cycle, everyone buys developed market credit first, right? So because that's what they're more familiar with, and particularly given how high US interest rates went in this cycle, everyone was just crowding into developed market credit. So now obviously what we've seen with this first 50 basis point cut by the Fed, typically what we always see is money flows back into emerging markets after the rate cutting cycle kicks off, because as investors find their interest rates falling in developed markets, they have to search for yield elsewhere. So I think we're sort of at the cusp of that. We do feel like money is going to flow back into this region, partly because of that. The other big factor is obviously a big part of the negative sentiment towards Asia has been China, right? Everyone's been quite cautious on China, and despite the fact that I think there's a number of incredibly interesting domestic stories, economic stories in Asia that really have nothing to do with China. So India, Indonesia, Japan are all doing really well. They have great stories economically. A lot of people from the outside looking in, when they think of Asia, they just think of China, right? So, when they get cautious on China, they just sort of divest their regional exposure to Asia. But we think given the measures that we've seen recently in terms of monetary stimulus in China, fiscal stimulus, I think, is likely to come through, maybe even have some structural reforms, let's see. But I think that's going to, at least shift the sentiment from a huge negative to maybe sort of neutral. And that would be a big, even just that shift to neutral, we don't even have to go positive, that would be a big factor in terms of money flowing back into this region.
I noticed, having said all of this, Australia is actually your second largest region of investment. So I'm curious, what do you like about Australian corporates, and how does it compare, say, with Asian corporates and corporates in the wider Asia Pacific region?
Sure, yeah. Australia's been a great opportunity set for us, actually. And it's quite interesting. So a lot of the Asian credit funds traditionally did not invest in Australia, right? So the index actually didn't include Australian credits. For us, we've been doing that. We've been running the strategy since July 2019. And that's always been, roughly 20% of our portfolio. Part of that is my background. I've done a lot of investing in Australia in my career. I've been in Singapore for 14 years, and throughout that time have been investing in Australia. And it is quite an interesting hedge in terms of, it's a bit more uncorrelated to what's happening in Asia credit, because Australia tends to be a bit more correlated to what's happening in developed markets. So can be an interesting sort of uncorrelated aspect that we can add to the portfolio. And we've been finding a lot of interesting value, because a lot of the we do both investment grade and high yield. In the high yield market, there isn't really a deep high yield investing community in Australia. So a lot of the companies raise money through the 144A market in the US. We've been actually able to get in front of a lot of catalysts and both value and event-driven opportunities relative to the global investor base.
Okay, that's really interesting. That I'm not going to say counter-cyclical, but we're definitely kind of that outlier, and that provides a benefit to your fund. So with that said, because I've asked you a question about Australian corporates, I bet you can guess what's coming. tell us about maybe a couple of Australian corporates you're invested in.
Sure, yeah. I mean, Santos has been our biggest long for over the past 1.5 to 2 years, actually.
Right.
So that's triple B investment grade name. It was actually one of the cheapest investment grade names in the entire region in all of Asia Pacific. And so yeah, we've done a lot of work. Our equity colleagues actually know the company really well as well. So we've collaborated on the research effort with them. That actually has done quite well this year. Obviously, they've had talks with Woodside on a merger. Even though those were called off, the spread compressed to around the level of Woodside, which was trading much tighter. And then recently there's been some speculation on M&A through the Middle East with Santos. So I think all of those have just sort of shown the market the value and why it was mispriced. So that's done quite well for us. We've also had some overweights in some of the financials, which have done well. There's been some recent revisions on bank capital rules, which has benefited our portfolio as well. So yeah, it's been a pretty deep opportunity set for us, and one that we think will continue to find opportunities.
And to clarify, when you say financials, are you talking about specifically the biggest banks, kind of like that Big Four?
Exactly. Yeah, that's right. But they have various parts of their capital structure, subordinated, tier 2, et cetera, AT1s, tier 2, et cetera.
John Stover of Tribeca, thanks very much. And thank you for joining us for The Pitch. If you enjoyed that interview, you can subscribe to the Live Wire Markets website, as well as our YouTube channel. We'll see you again soon for more of The Pitch. Bye for now.